Imagine waking up one morning and seeing headlines like markets plunge 800 points, recession fears grow, investors panic as inflation spikes. You check your portfolio and it's dropped. Your heart rate jumps. You feel that sinking feeling in your stomach. What do? Panic? Do you sell everything? Do you wait it out? Here's the truth. The wealthy don't react the same way as everyone else during market volatility. And it's not just because they have more money. It's because they follow a completely different set of rules. In this video, I'm going to show you the 3 things wealthy investors always do during turbulent markets, and how you can use the same strategies to stay calm, stay confident, and stay on track, even when the news is screaming otherwise. Hi, if you're new here, my name is Stefano Francesca. I'm a certified financial planner professional at Next Step Wealth Management with IPC Securities Corporation. For over 30 years, I've helped Canadians take control of their finances, navigate volatile markets, and retire with confidence. Whether you're building wealth, approaching retirement, or just trying to make smarter financial decisions, this channel's for you. If you find value in this type of content, make sure to like this video, subscribe, and hit the bell so you don't miss out on future uploads. Now let's talk about how to stay calm when the markets get rocky and the 3 things the wealthy always do differently. Part 1, wealthy investors don't react, they reframe. When markets are volatile and headlines are screaming words like crash, correction, or recession, what's your first reaction? For a lot of people, it's the panic. Refresh the news, check their portfolio 3 times a day, maybe even wonder if they should sell before things get worse. But the wealthiest investors, they do the opposite. They zoom out, not in. Instead of getting stuck on the day-to-day noise, they step back and ask, what does this actually look like in the context of my 20, 30, or 40-year plan? Because when you zoom out, historically speaking, market volatility isn't an exception. It's the rule. Let's look at the data. The stock market, on average, drops 10% or more every 1 to 2 years. About once every 5 years, it drops 20% or more. And yet, over any 20-year period, markets have historically gone up. That's not optimism, that's just what the long-term data shows us. But if you're zoomed in, watching the daily drops, reading fear-driven headlines, it doesn't feel like that. It feels like chaos. It feels like you're losing ground. So the wealthy treat market volatility the same way a pilot treats turbulence. They stay the course, trust the systems in place, and keep flying towards the destination. They know short-term pain is often the cost of long-term progress. And this is where having a clear financial plan helps. Because if you know what your money is for, when you actually need to use it, and how your portfolio was built to support those goals, then volatility becomes just noise, not a crisis. Without a plan, you react emotionally. With a plan, you respond strategically. So if you find yourself stressed during a market dip, ask yourself, is this money I need next month or 15 years from now? Because how you answer that should drive your decisions, not the headlines. Part 2, they focus on what they can control. When markets get shaky, the average investor starts obsessing over the wrong things. Headlines, predictions, even social media rumors. But wealthy investors, they ignore the noise and zero in on what they can control. Let me give you an example. A client called me during a market downturn, totally panicked. Headlines were saying it was the worst quarter since 2008, and he was ready to pull all his investments into cash. But I asked him a simple question: has anything in your personal financial plan actually changed? His answer was no. He still had a long-term time horizon, a well-articulated investment approach, he had emergency cash set aside, he had a plan for withdrawals that didn't rely on selling in a down market. And once we talked and walked through that, the panic faded. Why? Because the plan hadn't changed. Only the noise around it had. Wealthy investors understand that you can't control what the markets do week to week or day to day, but you can control how you're allocated across stocks, bonds, and cash, how often you check your portfolio, how much you spend during uncertain times, and most importantly, whether you stick to the plan or not. Market volatility is normal. It's built into the system. And if you have a strong financial foundation, then short-term drops shouldn't derail your long-term goals. So when things get rough, they don't panic. They pivot back to their plan and focus on the levers they can pull, not the ones that they can't. Part 3, they use volatility to their advantage. For most people, market volatility feels like a threat. It's unsettling, it triggers fear, and the natural instinct is to react, to go to cash, to hit pause, or to make a change just to feel in control. But wealthy investors, they've trained themselves to reframe volatility as opportunity, not something to fear, but something to work with. They understand that downturns are not anomalies. They're built into the market cycle. And instead of trying to predict the bottom or react emotionally, they ask, how can I use this moment to strengthen my long-term position? Here's what that looks like in action. Firstly, they buy when others are fearful. Rather than pulling back, experienced investors often see market dips as a chance to invest more, knowing knowing that temporary declines can lead to long-term gains. They view volatility the same way that they view a sale on something valuable, a chance to build ownership at a lower price. Secondly, they rebalance, not react. Volatile markets can shift the balance between asset classes like stocks and bonds. Instead of panicking, wealthy investors use this as a chance to restore original alignment with their original strategy, buying more of what's dropped in value to keep their portfolio on track. Thirdly, they stay focused on goals, not noise. Most importantly, they anchor themselves in their long-term plan. If nothing in their personal financial picture has changed, their income, goals, or time horizon, then there's no reason to abandon course just because the market is temporarily down. While the average investor is glued to headlines and refreshes their portfolio every hour, the wealthy are calmly recalibrating, leaning into the discipline that got them where they are, and positioning themselves for what's next. Because in the long run, volatility isn't the enemy. It's often where opportunity hides. Part 4, they rely on a real plan, not gut feelings. Let's be honest, when the headlines start flashing red, it's easy to feel anxious. Markets drop, news cycles go into overdrive, and your investment account takes a hit. That moment is when panic usually kicks in. But here's the key difference between those who stay calm and those who don't. The calm ones aren't guessing. They have a plan. And I don't mean a hope for the best kind of plan. I mean a detailed, personalized financial roadmap that anticipates volatility and shows exactly how to navigate through it. Wealthy investors don't rely on gut feelings or daily headlines to make decisions. Instead, they know their income needs and how they'll meet them, regardless of short-term market dips. They have structured withdrawal strategies that don't depend on selling during downturns. They hold enough liquid or conservative assets to weather temporary turbulence without stress. In fact, many have 12 to 24 months of cash or fixed income assets set aside for day-to-day expenses. So they're never forced to sell long-term investments at a loss just to pay the bills. They've also worked with an advisor, someone like me, to run through different what-if scenarios. What if the market drops 20% in year 1 of retirement? What if interest rates stay high for the next 5 years? What if inflation eats into purchasing power faster than expected? When you've planned for those scenarios in advance, a downturn doesn't become a crisis. It becomes part of the strategy. The immensely successful Warren Buffett said that to invest successfully over a lifetime does not require a stratospheric IQ, unusual business insight, or inside information. What's needed is a sound intellectual framework for decisions and the ability to keep emotions from corroding that framework. And that's the real benefit of having a plan. It doesn't just manage your money, it manages your emotions. Because once you can see on paper that you're still okay, that your plan still works, and that you've already accounted for bumps in the road, you stop reacting emotionally. You stay focused on the bigger picture. And for investors, that's often the difference between staying on track and making costly mistakes when the pressure's on. The truth is, volatility is part of investing. The downside is never comfortable, but it's also never permanent. The most successful investors aren't the ones who time the market perfectly. They're the ones who prepare, stay disciplined, and stick to a strategy that's built to last. And if you don't feel like you have that kind of clarity right now, if the headlines are stressing you out, or you're not sure your current portfolio fits your goals, let's fix that. If you want to build a portfolio and a retirement plan that keeps you calm and in control, even in the face of market volatility, click the link in the description to book a discovery call with me. I'd love to walk through your situation, answer your questions, and help you build a plan that works in real life. And if you found this helpful, hit the like button, subscribe to the channel, and drop a comment below. What's your biggest challenge when markets get rocky? I read everyone. Thanks for watching, and I'll see you in the next video.